Hello everyone. In light of the market volatility, we wanted to share a few thoughts. First of all, market setbacks are not new, and one doesn't have to go back far enough in time to realize that we've been here before. Just the last 5 years, you all have successfully navigated the fastest bear market in history following the pandemic in 2020. In 2022, again, we had another bear market, one that was more prolonged as inflation spiked. The Fed also rushed to aggressively hike interest rates, and we all lived through the deepest bear market in bonds. Now, the recent version is tariffs and trade uncertainty that are driving the sharp pullbacks that has played out over the last couple of trading days. What is driving markets is the newly announced sweeping tariffs by the US administration that were higher than most investors expected. We have 10% tariffs on all imports that took effect on Saturday, April 6th, and higher tariffs on 60 countries that the US has the largest trade deficit, with that going into effect on April 9. Together, they are projected to push the average tariff rate to almost 25% from about 2%, which would be more than a 100-year high. In terms of what's next, some countries will choose to retaliate. China has taken that route, that approach, while others are now trying to negotiate. Japan is on the latter camp, and according to Treasury Secretary Bessent, Japan is expected to get priority in the trade talks. The hope is that the proposed high tariffs will represent a ceiling and can be negotiated down from here, but uncertainty will likely remain high while all this is playing out. From an economic perspective, tariffs pose upside risks to inflation and downside risks to economic growth, as they may act as a tax on the consumer. They may also pressure corporate profits via higher input costs and slower demand. But there are buffers, or let's call them mitigating factors. First and foremost, the US economy is facing this period of uncertainty from a very strong starting point. Whether we look at consumer finances, corporate balance sheets, or the labor market, all point to healthy conditions. And we do not see any major imbalances or excesses in the economy like in 2008 that would trigger a more prolonged and deeper financial crisis or a downturn. Another important point to note is that what has been driving markets is all policy driven. And most likely the policy agenda from the administration may soon shift to pro-growth measures. A lot of the focus early in the year has been on trade and efforts to constrain government spending. However, the administration may start pivoting to more market-friendly policies like tax cuts and deregulation, which are taking longer to implement. Next, unlike the bear market in 2022, the Fed remains in a rate-cutting cycle and could step in to cut interest rates more aggressively than expected if there is a notable uptick in unemployment. They've already told us that they are inclined to see any tariff-induced price increases as a one-off or transitory. And then, lastly, we hear a lot of talk about an upcoming recession. While certainly risks have increased, a recession is not inevitable. Markets have already priced in a significant degree of downside, in our view. On the graph, you can see that based on the S&P 500 17.5% decline from the highs, that implies a 60% chance of a recession based on how stocks have behaved during past recessionary periods. We can go through the same exercise for small cap stocks, and that implies an 84% chance probability. The point here is that stocks are starting to get priced for an outcome that may not materialize. Elevated valuations was one concern coming into this year. Well, the upside of a down market is that valuations are now looking more compelling. All major indices are trading below their 10-year historical averages when looking at the price-to-earnings ratio. Even the Nasdaq, that includes a lot of the mega-cap technology companies, has flipped from trading at a premium to its history to trading at a discount. Mid-cap stocks continue to look attractive to us and offer a nice balance between quality and that catch-up potential to large caps. One key takeaway, looking at how markets have behaved over the last trading sessions, is that investors that own various asset classes, those that are diversified, have fared better than some of the main averages. So diversification has helped portfolios better weather the storm so far. So far, this year's performance is exactly why the portfolios that we recommend don't just include the S&P 500. We have allocations to 13 asset classes that include mid-caps, international, even emerging market debt, among other asset classes. While the Magnificent Seven group of companies have turned from leaders to laggards, international equities are still lower but have outperformed, and investment-grade bonds are up year-to-date, providing that balance to portfolios and offset to equity market volatility. You can also see our portfolio objectives that are based on our strategic asset allocation guidance and how they are performing. Most are down, but not nearly as much as the S&P 500 or a simple benchmark mixing US stocks and bonds. Pivoting to some interesting observations from the recent market action. We look at the so-called fear index, or VIX, which the higher the index, the more volatile markets are. And what you find is that it's been only 8 times over the past 35 years that this index, the VIX index, has been as high as it is now. After we cross that threshold, the 3 standard deviation threshold, which you can see on the graph, forward 6 and 12-month returns tend to be very strong. On average, it takes a while for volatility to return back to normal, about 8 months. But what we find and what history shows is that fear creates opportunities. As Warren Buffett has famously said, be greedy when others are fearful, and be fearful when others are greedy. And that's exactly what historical data show. Another interesting stat, looking at Thursday and Friday last week after the April 2nd tariff announcement, combined, the performance for these 2 days was the 4th worst in the S&P decline since World War II. Past episodes included Black Monday, the pandemic, and the financial crisis in 2008. During these extreme sell-offs, returns have been consistently positive across various time frames. Of course, there's no guarantees, but after what has transpired in equity prices, possibly a lot of bad news are in the price. To conclude, we'd like to offer some investing rules of the road, some guidance to think long-term but also navigate the here and now. Starting with a focus on what you can control. In this environment, patience will be critical to navigate all the headline noise and announcements. It is very important to avoid making emotional decisions, which we know based on research, they tend to lead to subpar outcomes. There's a study, it's called the Dalbar study, that shows the returns achieved by the average investor versus the benchmark. A lot of the mistakes, investing mistakes, happen when investors are trying to time the market and they tend to get out at the wrong time. And lastly, it helps to understand the risks of not investing if you have long-term goals that you want to achieve. To make this statement more tangible and real, assuming 3% inflation, prices will double during a normal 25-year retirement period. So it is very important to own assets that can help you maintain your purchasing power over time. For more personalized advice and guidance on how to navigate the market pullback, please consult your Edward Jones financial advisor.